Welcome to this revision video for GCSE Modern History, Unit 2, the United States from 1919 to 1941. In this video we're going to be looking at the Wall Street crash of October 1929. The Wall Street crash was one of the seminal events of the period. It was the point at which the boom years of the 1920s gave way to the depression years of the 1930s. It was the point in which divides this unit of work, and also in many historians' minds divides the early part of our period from the later part of our period, and as I say, prosperity giving way to adversity and depression. Now, what was the Wall Street crash? The Wall Street crash was a period in late autumn and winter of 1929 in which the US stock market collapsed. The US stock market lost over 2/3 of its value in the course of 7 weeks of trading. Now, this video does assume that you will have checked out the video on what a stock market is, or what Wall Street is, which is also available through Art Vega, so I'm not going to spend any time talking about how the stock market actually works in this video. It's enough for now that you recognize the seminal event, the main event of the Wall Street crash, was something we call Black Tuesday, or October 29th of 1929. On that day, there was panic selling. 16 million shares were sold in a single day, and the losses that were sustained during this period took 25 years to recover. Stocks were not at the same level for another 25 years. It was 1954 before they achieved the same level they had in early October of 1929. That's just an enormous loss. Now, a typical question that might occur in your GCSE exam is what caused the Wall Street crash? And although there is no consensus on this, historians will disagree, there are principally 4 factors that we might want to focus on today. The first is overproduction, second is heavy borrowing in a variety of different forms, the third is government policy, and finally we come to speculation, the most commented cause of the Wall Street crash. Let's start with overproduction. Now, mass production was a phenomenon of the 1920s. In the 1920s, industrialists and entrepreneurs like Henry Ford had developed assembly line production. This was the process whereby many people would work on a single moving assembly line, placing very small components to manufacture a much larger good, something like a car, a radio, a form of electric lighting. So large numbers of people with very specialized roles could produce much more cheaply very large quantities of goods, as I said, like motor cars, but also other types of consumer goods. That production dramatically accelerated US economic growth in the early part of the 1920s, but inevitably demand for these products was limited. You cannot expect to sell someone a radio in 1927 if you sold them one in late 1926, and sure enough, by the late 1920s, it was clear that the massive increase in production that assembly lines had made possible was reaching the limits of demand. There simply weren't enough people with enough disposable income to keep buying all of these goods, and that meant that inevitably the companies manufacturing those goods would see a fall in their profits. Now, the second major root cause for the Wall Street crash was the massive growth in credit or borrowing over the course of the decade. And that really has a number of factors. The first was wage stagnation. Now, wages did not grow as fast as the overall economy. The average working man's wages did not grow as fast as his spending. And he bridged the gap between those two things by borrowing money. There were a number of different ways in which you could borrow money in the 1920s. There was traditional bank lending. And traditional bank lending, as it says here, could be in a number of forms, but most obviously mortgages. Banks in the United States lent mortgages very indiscriminately in the 1920s. It was very easy to borrow money, and people did in very large numbers. Second, a new development was hire purchase. Now, this involves buying consumer goods, cars, radios, refrigerators, by making only a small initial payment and then spreading your payments over the course of many months or even years. That involves people acquiring increasing amounts of debt. They have to borrow that money somehow. The fourth, and in some ways most significant in relation to the crash, was something called buying on margin. Now, this is a technical procedure whereby if you are an investor, someone who wants to buy stocks, you are able to borrow money in order to buy those stocks. That places you in a very difficult and dangerous position. It means that if you borrowed $100 to buy a stock, and that stock should increase in value, then you will make an enormous amount of money because you've effectively locked in that gain for free. But if you buy that stock, if you borrow that $100 and that stock declines in value, it falls in value and is now worth only $50, your debt remains fixed at $100 and the asset you own is worth only $50. So that's a clear $50 loss that you have to fund somehow, and you are likely to sell that stock, making the crash even worse. Now, the third contributory factor was government policy. During the 1920s, the US government had embraced something called isolationism, or indeed in some cases financial isolationism. And although that's a big word, all it really means is that the US government wanted to tax foreign imports. It wanted to make it more expensive for people to buy goods manufactured outside of the US and less expensive to buy for goods that were manufactured inside the US. And that sounds all fine and good, but it has one major problem. It assumes that your trading partners, in this case European economies, would do nothing to defend their own exports. And of course they did. In response to a tax on their goods in the US, they simply taxed US goods being sold in Europe and elsewhere in the world, which meant that demand for those goods fell. So remember, we started by talking about overproduction. Those goods that were being produced by American companies were seeing falling demand at home, and now, as a result of government policy, falling demand abroad also. Finally, we're going to come to speculation, and this is the cause that is most commonly associated with the Wall Street crash, although it's arguably the least important of the things that we've talked about. By 1929, it was clear that stock buying was a very widespread pursuit. More people were buying stocks than at any point in US history. Ordinary people, people who had never previously been involved with the stock market, shoeshine boys, people who worked in ordinary jobs, who were market traders, who were people working in clerical jobs. They were investing very, very heavily in the stock market, encouraged by the fact that stock prices had risen so dramatically in the 1920s. When they became active, they continued to drive up stock prices. Because they were another source of demand, they meant that stock prices began to defy gravity. And when we say that, what we mean by defying gravity is that stock prices no longer had anything to do with the profitability, the underlying profitability of the companies who issued the stock. So as you'll know from the video on how the stock market works, stock prices should reflect the profitability of the companies that issue the stock, companies like Ford. However, if Ford's profitability is falling, but demand for Ford stocks remains very high, then that stock price will continue to rise. It will defy gravity, which means that when the inevitable happens, when enough people realize that Ford's profitability is falling, or another company's profitability is falling, the fall in share prices will be dramatic. And that's exactly what we see in the Wall Street crash. We see a dramatic 2/3 decline in stock prices over the course of just a few short weeks, wiping out the wealth of very large quantities of numbers of Americans and setting off the Great Depression.